Are you interested in learning how to trade options and make profits? In this video, we will dive deep into the world of options and learn step by step, making it easy for beginners to understand. I will start by explaining the basic of options, including the difference between calls and puts, and key terms like strike price, expiration date, premiums, and the GITs like delta, data, and IV. Next, I will guide you through the process of buying and selling options, highlighting the risks and rewards of each approach. Whether you are buying options to speculate the price movement or selling options to generate income, understanding how to execute this trade effectively is crucial for success. I will also cover popular option trading strategy such as covered call and protective puts. Each of these strategies can help you generate income or hedge your portfolio. But knowing when and how to use them is the key to make consistent profits. Risk management is the centerpiece of option trading, and we will discuss how to protect yourself from big losses through practices like position sizing, setting stop losses order, and diversification. Plus, I'll be giving you important tips to minimize your risk and maximize your returns. By the end of this video, you will have a solid understanding of the core concept and strategy of option trading, so you can confidently take your first step towards a profitable trade. Learn the basic of options. To successfully trade options, it is essential to understand the foundation concept of option trading. Here's a breakdown. Call and puts. A call options give the buyer the right to buy an underlying asset at a predetermined price, which is the strike price, on or before the expiration date. Traders buy call options if they expect the price of the underlying asset to increase. A put option gives the buyer the right to sell the underlying asset at a specific strike price by the expiration date. Traders buy put options when they expect the price of the asset to decrease. Strike price. The strike price is the price at which the option holder can exercise the options to buy or sell the underlying asset. It is an important factor in assessing whether an option is in the money or out of the money. Premium. The premium is the price paid to purchase an option. It's determined by several factors, including the current price of the underlying asset, the strike price, the time left before expiration, and the market volatility. The premium is paid upfront by the buyer to the seller of the option. Expiration date. Every option has an expiration date, which marks the last day the option can be exercised. Options are time sensitive, and as the expiration date approaches, the option value can decrease due to time decay factor. It's critical to understand how expiration affects your trade and the overall option value. In option trading, the GIGS refers to the key variable that affects the price of an option. This variable provides insights into how options are priced, how they change over time, and how different market factors can influence their value. Understanding the GIGS is critical for making informed decisions when trading options, as they help you manage risk and develop more effective strategies. Now let's talk about call and put options. A call option is an option contract that gives the right but not the obligation to the buyer to buy the underlying asset at a specific price and a specific time range. You pay a fee to purchase a call option, which is called the premium. This pay charge is the maximum you will lose in a buy call option. When we talk about buying a call option, we are making a bet that the stock will increase over time. A long call option is the standard call option in which the buyer has the right but not the obligation to buy a stock at a specific price in the future. The advantage of a long call is that it allows the buyer to plan ahead to purchase a stock at a cheaper price. For example, if a long call option with a $100 strike price is purchased for $5, the maximum loss is defined at $500 and the maximum potential is unlimited if the stock continues to rise. However, the underlying stock must be above 105 at expiration to realize a profit. This example shows that you are bullish with the stock and believe that it will increase within a specific period of time. You can choose 30 days for the expiration date. If you buy a call option, it will be in this way. Strike price 100, 30 days expiration date, premium $5, which is $500, because one contract will be 100 stocks. The worst case scenario will be stock price drop and it is below $100, which is your strike price. You will lose $500. Best case scenario will be strike price increase a lot and your profit will be unlimited. The next example will be selling call option, which is called short call options. As its name indicated, a short call option is the opposite of a long call option. In a short call option, the seller promises to sell their shares at the fixed strike price in the future. Short call options are mainly used for covered call by the option seller or call option in which seller already own the underlying stocks for their option. Covered call. A covered call strategy involves owning the underlying stocks and selling a call option on it. This is a great way to generate income from the premium you collected while holding the stock. If the stock price rises above the strike price, you may be required to sell your shares, but you keep the premium as a profit. Personally, I prefer to be a seller of options than buyer option to generate more income. For example, if you purchase 100 of stock XYZ at $100 per share, you can sell a call option at the strike price of 105 for $5 for an expiration date of 30 days. Worst case scenario will be stock price drop a lot and you will be exposed for unlimited loss. If the stock closes below the short call at expiration, the option will expire worthless and the credit received will remain. However, if you will still earn the premium that you collected, which is $500, usually for covered call, I will only own stocks that I'm willing to hold over the long term, so the worst scenario with unlimited losses will be highly unlikely. Best case scenario will be the stock price increase to 105 and you earn the premium of $500 and also the capital gain from your stock, which is 105 minus $100 is equal to $5. $5 times 100 share equal $500. So your total profit will be $1,000. Now let's talk about put options. A put option gives the buyer the right to sell the underlying asset at a specific price by the expiration date. Traders buy put option when they expect the price of the asset to decrease. For example, if you buy a put option with a $100 strike price is purchased for $5, the maximum loss is defined at $500 and the profit potential is unlimited until the stock reaches $0. However, the underlying stock must be below $95 at expiration to realize a profit. This example shows that you are bearish with the stock and believe that it will decrease within a specific period of time. You can choose 30 days for the expiration date. If you buy a put option, it will be in this way. Strike price $100, 30 days expiration date, premium $5, which is $500 because one contract will be 100 stocks. Worst case scenario will be stock price increase and it will be above $100, which is your strike price. You will lose $500. Best case scenario will be stock price decrease a lot and your profit will be unlimited. The next example will be selling put options, which is protective put options. You can sell a put option at a strike price of $95 for $5 for an expiration of 30 days. Worst case scenario will be the stock price dropping a lot and you will be exposed to unlimited loss, which means that at expiration you are required to purchase 100 shares of the stocks. However, you will still earn the premium that you have collected, which is $500. Usually for protective put options, I'll only do it on stocks that I'm willing to hold over the long term, so that the worst case scenario with unlimited loss will be unlikely. The best case scenario will be the stock price maintaining above $95 at expiration, which the option will be expire worthless and the credit received will remain. Next, I will explain the Greeks in option trading. The Greeks refer to a set of metrics that helps trader evaluate how various factors impact the price of the option. They represent how an option price will change based on movement in the underlying stock, time decay, and volatility. Knowing how to read the Greeks is critical for optimizing your option trade strategy. Personally, I'm an option seller, so I focus on these three Greeks, which is delta, data, and IV volatility. How delta relates to win rate. A 70% win rate typically means that a trader expects to win 7 out of 10 trades. To relate delta to a high win rate like this, let's break it down. The delta of an option gives the estimate probability that the money will be in the money. For example, delta of 0.7 suggests that the option has 70% chance of expiring in the money. If you are buying a call option with delta 0.7, this means that there's a 70% chance that the option will end up profitable or in the money when it's expired. Delta as a win rate indicator. A high delta can be a sign of a high probability of success. Here's why. When delta is 0.7, it means that the underlying asset price has to move less for the stock to become profitable compared to a lower delta of 0.2. Traders often use delta as a way to assess the probability of success. A delta of 0.7, it means that a 70% chance of your trades being profitable. Trader looks for high win rate. This strategy allows them to measure a higher probability of success and minimizing risk. Data, time decay. Data measure how much an option price will decrease as time passes, with all other factors remaining the same. Options lose value over time, and data is a measure of how much value will be lost per day as the expiration date approaches. For example, if an option has a data of 0.05, it means that every day the option price will lose 0.05 in value of time decay, all other things being equal. Why is data important? For data, as time passes, the option you sold lose value, which you can profit from if the option expire worthless. If you are selling option, you can profit from data decay by taking advantage of the time value that erodes over time. The third, implied volatility. How does implied volatility affect the pricing of options? Implied volatility, IV, represent the market expectation of the future volatility of the underlying asset. It is a measure of how much the market expects the price of the asset to fluctuate during the life of the options. IV increase where traders expect high price movement in the future, often due to news, earnings report, or economical events. Higher IV means that the option premium will increase because of the expected movement of the asset is higher, leading to a higher potential for profit. Lower IV means that the option will have a lower premium as there is less expectation for large price movement. For example, the IV of a stock of 30%, it means that the market expects the price to move 30% up or down over the next year. Why is this important? For option seller, you want to have a higher IV to have higher premiums. How the Greeks works together. Now that we have understand the individual Greeks, it is important to know that they don't work in isolation. Each of the factors interact with one another. And as an option trader, you will need to consider them together. Understanding the Greeks helps with your option tradings. Whether you are managing risk, making decisions about enter or exit of your trades, it is important based on the Greeks as well as the market condition. Delta tell you how your options will react to price changes in the underlying asset. Data show you how time affect your options, and implied volatility IV shows how volatility impacts the cost of your option. By learning to integrate this factor, you can make more informed decisions, minimize risk, and maximize return in the world of option trading. By now, you should have a solid understanding of the basic of option trading and the importance of strategy you can use. Remember, option trading is a powerful tool and requires careful attention and discipline for your risk management. Practice makes perfect, so remember to try it on demo accounts before diving it into the live market. Do like and subscribe to my channel for more content of option trading. If you have any question, do leave your question in the comment section below. I'm happy to answer them.